Welcome back, everyone. Today's video is a bit different from the normal subjects that we cover here, but today's video is about dividend investing and a few thoughts about it and a bit of a dive into what could go wrong. So what's the deal with today's video? Well, I have a friend who's really into dividend investing. And honestly, I understand why. It's great to see the results. It's great to, on an ongoing basis, get paid for your investments. And it's a steady source of income, which is really useful to a lot of people. Now, despite what you may believe about this channel, and we haven't fallen into some alternate reality parallel universe here, I actually like dividends too. I like getting paid my dividends when it makes sense for the company. The thing is, there's a number of people and a conception out there that dividend paying companies are safer than other companies because they will keep paying their dividend come hell or high water, and that makes them safer. So the problem is that often the companies with the big dividends are not necessarily safer and may actually be riskier because they pay the big dividends. And so let's have a look at this in today's video. So the concept of dividend investing is owning companies that pay big dividends. And I think a number of people that like dividend investing might point to something like the SPHD, which is that Invesco S&P 500 high dividend, low volatility ETF, as a good way to be diversified and play the dividend investing. Now, this ETF yields in dividends 4.3% and carries about 40 different companies. So some might say that this is a low risk, highly diversified, great way of dividend investing. But we're going to look at what's good and what might not be so good about something like this ETF. So let's start with the reason why someone might buy an ETF in general. Diversification. Diversification is a great way to reduce risk in the failure of certain individual aspects or within the portfolio on something like a high dividend ETF, the failure of a particular thesis. Now, what's a thesis? Let's just quickly go through. Thesis could be that the oil price will go up, so invest in oil. Now, you can't diversify that thesis by owning 500 different oil stocks as the diversity in your portfolio, because if your main thesis is wrong, the whole thing's wrong. Now, in the case of the SPHD, you often have plenty of different companies from different walks of business, if you will, but often they all have a high dividend. And so the thesis is that if the share price goes down, they will still pay their dividends. So you're diversified. But that may not always be true because many of these companies, as I'll show, often carry the same types of risk. So when we're looking at dividend ETFs, I think it's important to realize that the market as a whole pays 1.75%. Dividend stocks are not these forgotten things that are not included in the market. They're just companies that have chosen to pay out more money and grow less as a result. Or they have a higher dividend because the market thinks of them as riskier in some way. Normally, this is due to them having an excess amount of debt. So you'll often look at a company and you'll be like, whoa, well, why does this pay 7.5%? It's a good company, I've heard of it, whatever. Well, maybe it just has a lot of debt and the market's not completely convinced that they can survive a rough ride. And if a company has too much debt and it can't pay the interest on that debt, well, it certainly won't be paying a dividend in the future. So let's look at the dividend investing thesis. The thesis is you still get your dividends in times where the share price might decline. Okay, so let's look at the last part of that. Because if something's going to go wrong, let's look at what happens when that would cause something to go wrong. So a share price might decline because of recession, which would lead to uncertainty in the future and the company's fundamental picture potentially being worse. Also, if the market becomes concerned that the company won't be able to pay their debt, then the share price might decline because well, you certainly can't pay a dividend if you can't pay off your debt. So, as a whole, the share price would most likely decline if the business prospects for the company got worse. So let's work a little further with the what could go wrong part of the thesis. Some, again, not all of these companies, but some are quite vulnerable. Remember what I said about the high yield in the dividend being due to debt? Well, let's look at if there's a recession and suddenly a company can't make money. If it has no debt and it can't make money for a while, it might suck, but it's not a huge problem. The company can survive, and if they can pick up in business, again on the other side of the recession or the challenging times or whatever, then they can go right back up. But if a company with tons of debt suffers upon tough times, the very survival may be at risk. And often, I'll get to this in a sec, but a company might fall 60, 70, 80% and then realize that they really have to cut their dividend. So my point is merely that the recession or the tough times, or it doesn't have to be a recession, I'll show you some examples in a sec. But the tough time that a company comes across are times when the share price declines because they're having trouble making money. So some of these companies with very high dividends, you see a recession plus lots of debt equals the companies might be really at risk in some cases. And often in some of these ETFs, you'll have a whole lot of companies that are in the same type of situation. Now, the other thing I wanted to say about some of these companies before I get into examples of what can happen sometimes when a company tries to do something different from what the market thinks is wise, is that some of these companies pay high dividends or have high dividend yields because they pay an unsustainable amount. And by this, I mean they might pay out more money in dividends than what they earn. Never mind what they can afford to pay out and keep growing their business. They might be paying out more than what they earn. And my point is that when you pay out more than what you earn, you're doing this by adding to your debt in theoretically good times. Well, in theory, they can do this in bad times, but if they're doing this in good times, I don't know what happens in bad times, but I can maybe guess that it's not good. And my point is, if you look at how this would play out over the long term, it means that companies are sacrificing their ability to pay future dividends by tacking on debt now, debt that they'll have to pay interest to later, and it's highly unsustainable. So this example is Briggs and Stratton. You've probably heard of it. They make a number of lawn equipment and engines and generators and things like that. So this is a maximum chart. This is from the 70s all the way to today. And as you can see, it looks like a solid company for most of the time. And they paid 2% dividend for many, many years. 2%, 3%, up to 4%. Then all of a sudden, in late 19 or maybe 18, something changed. And all of a sudden, quite quickly, honestly, they started falling. And then all of a sudden, they were paying a 4% dividend, 4.5% dividend, 5.6% dividend, because the share price declined, because the market was concerned. So then in early and mid 2019, they were paying all of a sudden 5.5%, until they finally realized that they had more than 1 or 2 quarters of rough time and that they were having some troubles. And finally, they cut their dividend. Now, they didn't cut it completely, but it is down significantly, and the stock is, well, it's down 85% in 2 years. So it's just an example of how a stock can fall a lot and then realize it has to cut its dividend. And this is a company you've probably heard of. Now, this is another example. This is Chorus Entertainment, and fair warning, it's probably a bad stock to own because I own it. And my point is that for a number of years, this company was paying a dividend and growing its dividend every year, until all of a sudden its pace of dividend growth exceeded its pace of growth. And you could probably notice approximately where that is. And so the company started declining, and it looked like it was getting attractive. The yield was going up and up and up and up and up. And the point is, this continued until all of a sudden in 2018, you can probably see that big red candle. Actually, I think it's the second big red candle, close to the bottom, where they finally were yielding about 20% and they cut their dividend by 75%. And so then now they're yielding about 5%. And you know what? They could probably eventually raise it, but they decided that the company needed to survive and they had to see to their debt. And so now it looks very similar in terms of dividend yield to how it looked when it was $25 a share. Only difference is now it's $5 a share, still paying a 5% dividend. And remember the second thing I said with regards to companies paying out more than they're making? So I was looking through an ETF that a friend was talking about, the SPHD ETF, and I saw that I was just looking through the top 10 holdings, and I admittedly didn't do a deep dive into these companies to know if the payout ratio is right or if there's some one-time effects or whatever. But I just looked at the top 10, and here are 4 examples in the top 10, which consists of these, another 4 companies that are, well, in a reasonable payout ratio, and 2 tobacco companies that are just rolling in dough, but no one cares because they're tobacco. But these 4 all had payout ratios above 100%. The highest was Iron Mountain, which first I didn't know it was a real estate company, but I knew that it wasn't an iron mining company because there's no way an iron mining company could survive with $10 billion in net debt. It would just be done. No, gone. But anyway, they pay out 177% payout ratio means they pay out $17.70 for every $10 they make, if that's correct. And they're not the only one. You have AT&T there, which is probably a company that most of you have heard of. And they have a nice big dividend yield, but the company will need to grow to catch up with that dividend yield. And so my point is that we can't assume that just because a company is paying out a big dividend that they can afford to. So you'll see that in many cases, debt is the issue. Now, I wanted to put a focus on this because if you look at many of these companies with higher dividend yields, they're highly levered. Now, this makes sense if you think about it, because if you have a company that's a solid company and it yields 4%, well, that means if that's the entirety of the valuation, then it means you're paying 25 times earnings for the company. That's if they're paying out 100%. If they're only paying out 60%, well, then you're paying a really fairly decent valuation for the companies. So you have a lot of companies that are only paying out higher dividends percentage-wise of the price you're paying because they have some other questions. Now, this video sounded a bit dire at times, but I really wanted to clarify that there's nothing bad about dividend investing. It's a solid strategy, one which I will probably employ someday for a good part of my portfolio, hopefully. The point is that not all dividends are created equal. Sometimes you have a company that's yielding 3.5% that could be much more exciting than one yielding 5%. It all depends on what the rest of the company is doing. So the key takeaway that I want everyone to get from this video is that investing is being paid to take risks. If you take big risks, you can get paid a lot, and if you take little risks, you're more likely to only get paid a little. The key is finding situations where you're getting paid more for taking risks than the likelihood of things going wrong. So I'm not trying to convince you to not invest in dividend investing. It's a great strategy. Just be sure that you understand what the risks are in what you're buying. And if you're racing in front of picking up money in front of a steamroller, don't be picking up pennies. And with that, I will wish everyone a great day, and I will probably do a few more videos about dividend investing, but mostly still, what we normally talk about. So, best of luck and catch you next time.